Hi, everyone. Thanks for joining us. I'm Jordan Fry from the Prudent Plastic Surgeon. I'm excited to have you all here, and I am super excited to have Josh Mettle, who's from Neo Home Loans, with us. And it's really cool. So Josh and I kind of got connected, and he is just a wealth of experience when it comes to real estate. And what I think is interesting is in more than one arena, he's works with mortgages and is specifically focused on physician mortgages. So kind of on the residential side, which that for a lot of us can seem like a bit of a black box. He has a lot of experience with that, but he also has over 20 years of experience as a real estate investor and has been doing it really successfully on a huge scale for a long time. So I learned a ton from him. And so that's why I was so excited to invite him to come and speak with all of us. And with that being said, Josh, I'll let you kind of jump in and introduce yourself further and go into the topics that you're going to cover today. And then everyone feel free, as we're going, leave any questions or comments in the chat, and we'll definitely make sure we carve out some time at the end for a live Q&A with Josh. So take it away.
Thanks, Jordan. It's great to be here with you and with the Prudent Plastic Surgeon community. This is really an honor for me. And I think I'll just maybe give a little bit of background in terms of context while we're waiting for the last few people to come in. The last 12 years, we have really specialized in doing physician financing for both primary residence and investment properties. And so that gives me the context of talking to physicians and other clients, investors all over the United States, which is kind of a cool purview because I get to see their financial situation. I get to hear in live time what they're thinking. Are they bullish? Are they bearish? Are they afraid? Are they greedy? What's happening inside their minds? That's kind of a cool context that I get to talk to so many people, literally from California to Florida every day. But in addition to that, my mother and I started a real estate investment business 22 years ago, and we purchased our very first rental property, which I'm proud to say we still own today. And in the last 22 years, the team or the family office has kind of grown. And today we own and manage over 200 rental properties in Utah, all in Utah. So we own single family homes, we own small apartment buildings, we own office buildings, we own retail centers that have like big fives in them and that kind of stuff. We own 5 different medical office buildings in Utah. So it gives me kind of an interesting perspective because I see into the lives of the everyday consumer all over the country in terms of seeing what they're grappling with in their financial situation. And then at the same time, I'm making decisions. Should I be buying? Should I be selling? Should I be refinancing? And so the perspective that I hope to bring to you tonight is one of an investor who owns properties and is constantly trying to evaluate the real estate market and is it on firm footing or not? And also one that has helped literally thousands of physicians over the last 12 years in virtually every state in the country. So that's kind of the context that I plan to bring this information to you. As Jordan mentioned to me earlier, this is kind of a conversational platform. So if you have questions or you want me to pause, feel free to throw those into the chat, and Jordan can tell me to take a time out and I'll pause and answer the questions. But if you're good with that, Jordan, I'm going to jump into the slides and we're going to jump into the data.
Yeah, let's go for it.
Okay, here we go. All right, so the topic of this presentation is real estate investing, recessions, and inflation. There's a lot going on right now in the economy. And then there's 5 strategies for physicians to thrive in this frightening market. Due to the amount of time we have, we may only give you 2 of the 5 strategies and then leave a cliffhanger for a subsequent meeting because I think we may run out of time to get through all 5 of those. The first thing that I like to point out is that there has been a lot of negative news about real estate, and the new kind of headlines are nothing new. In fact, these are quotes from Diana Olick. She's CNBC's senior real estate correspondent. And you can see going back to 2015, she said that housing today is a bubble larger than 2006. And coincidentally, that same year, homes in America appreciated at 5.1%. And if somebody would have listened to that headline and made a decision, well, I'm just going to time the market, they would have lost $15,000 worth of equity. This is kind of the national average home price year after year. And you can see in 2016, again, asserting we are in a housing bubble. Housing prices in the US go up another $17,000. In 2007, home ownership doesn't build wealth. Okay, well, another $20,000 worth of lost appreciation if we'd listened to that headline. 2018, it's better to rent than buy in today's housing market. Another $14,000 of lost equity for somebody trying to time the market. 2019, the housing market is about to shift in a bad way for buyers. Another $15,000 of appreciation nationally that year. And then December 2019, next year will be hard on the housing market, especially the big cities. 16% appreciation nationally, $61,000 of appreciation. And then in July of 21, the housing boom is officially over as new home sales fall to pandemic lows, $80,000 worth of appreciation. So my point is, trying to time the real estate market off of sound bites is really difficult. And I think the tragic piece to this slide is if someone would have been paralyzed and not able to make a decision and overcome these sound bites, there's real American families that potentially lost out on $222,000 worth of appreciation in the last 7 years. So what I try to do is to separate the sound bites that tend to get a lot of readership, the clickbait. I try to separate that from the real data and analytics, what I believe really is moving the market. And I try to do it in as fair and objective way as possible. This is just kind of interesting. This was as of July. I probably need to update this because the market's moved a bit since then. But it shows that in the first 5 full months of the year, real estate was up 9.8%. Treasury bills were down 0.9%. The broader U.S. bond market was down 10%. The S&P was down 18%. It's recovered a little bit, and we'll see where that goes in the next couple of months. And cryptocurrencies just got crushed, down almost 66%. But the question that I want to answer in this presentation for you all is twofold. Number one, why has real estate appreciated so fast? Like, what's up with that? 18% appreciation rates on top of a 16% year. And this year we're trending still towards 18%. Why? Especially when we're starting to see a lot of these other asset classes pull back. And then the second question I want to try to answer is it likely that we're headed for a repeat of 2007? Is 2022 have many of the same factors that we saw in 2007? And are we headed for another major real estate value correction? So that's what I hope to answer today. To the first question, why has real estate appreciated so insanely fast? I would say unhealthy fast. It needs to slow down. But why? What's going on there? And so I find this chart really helpful for me, and I'll try to explain it as succinctly as possible. Basically, it shows that from 1959 through 2012, the total amount of U.S. money supply in dollar terms grew from virtually 0 to 10 trillion. So it took essentially 53 years to go from 0 essentially to 10 trillion. That's a long time to get to that number. But to get from 10 trillion to 20 trillion, it only took us from 2012 to about 2001. It only took 9 years to double the amount of money in circulation. And today there's about $22.4 trillion of money in circulation, which is 150% increase from 2011. So if we take the context of monetary expansion and we overlay the definition of where inflation comes from and what inflation is for Milton Friedman, we can start to kind of put some of these pieces together. Milton was a very, very, very famous economist and somebody that I've read a lot from and listened to a lot of his recordings. And Milton said, inflation is, excuse me, let me start over. Inflation is always and everywhere a monetary phenomenon in the sense that it, meaning inflation, is and can be produced only by a more rapid increase in the quantity of money than in output. Now, let me simplify that. The only way inflation exists is if the amount of money created is greater than the amount of output of a product or service. Well, in this case, the output that we're going to measure the monetary supply against is housing starts, the number of new homes being built. We see that the amount of dollars in circulation went parabolic since, if we go back to if we go to 2001 to 2021, right? We see this massive increase here in dollars, but let's look what happened in output in terms of homes. Well, this was right about the time that home builders were demolished from the Great Recession. So this shows the number of housing starts going back to 1959. And if we were to draw a trend line to kind of smooth out the highs and the lows, we would have a trend line that's right about 1.6 million homes. Be right about here is the average number of homes that have been built going back all the way to 1959. Then something interesting happened. Right before the Great Recession, there was a significant run-up of the number of homes that were being built, the number of housing starts. We got all the way up to almost, in fact, just a little bit above 2 million housing starts. And then the Great Recession wiped out the home builders. And from, let's call this 2008, we break below the trend line that goes back 53 years. We break below 1.6 million housing starts, and we really never get above that 1.6 million average. We were a tiny bit above it in early 22, but really just get back to the trend line, which means you have from essentially 2008 to 2022, where we're building not enough homes to satiate the demand, while at the same time, we have this massive expansion in the number of dollars. So when we have an expansion in dollars and we have a contraction in output, we literally have the definition of inflation as Milton explains it. And that to me kind of gives me a foundational understanding of what's going on and helps me put everything in context. The other thing that's really important for us to look at is inventory. And we want to look at what happens when inventory is, what happens to home appreciation when inventory levels are above or below the trend line. So going back to 1992, we can see that the average number of housing inventory, this is of course according to NAR, the National Association of Realtors, has this kind of negative, this downward sloping trend line. But if you were to go back actually to 1982, this graph only goes to 92, the average of inventory is about 2.3 million homes for sale. And we can see in the great, right before the great, or I guess this would have been in the Great Recession, this is like 2008, the inventory of houses for sale in America got above 4 million. I believe the all-time high was just over 4 million. And then the inventory kind of continued to come down as builders were not building as many homes. The next generation, the millennials, started buying homes, inventory levels come down. And earlier this year in January of 22, we hit the lowest inventory of homes in 60 years. We got down to only 860,000 homes for sale. And today we're at 1.3 million homes for sale based on the numbers from the National Association of Realtors. Now, one thing that's interesting, I'll just point out here because there's some other numbers in future slides. The way the National Association of Realtors counts inventory is they count the number of homes across the country that are listed for sale and the number of homes that are listed across the country that are under contract. So if the home's for sale, active or under contract and hasn't closed yet, they count that in the available inventory. One of the slides I'm going to show you in a few minutes says there's only 860 homes for sale nationally, because that group, Redfin, they only show the actual active listings. They don't count the number of homes that are under contract. But that's just wanted to point that out because there's some conflicting information if you don't understand that. Now, this is homeowner year-over-year appreciation. And I'm going to lay these slides over each other in a moment. But going back to 1992, and this red line would be zero appreciation. So anything above the red line means there's positive year-over-year appreciation of the housing market. This is a national figure. And then anything below the red line is going to be depreciation. These are home values actually going down. So we can see that once we went into the Great Recession, we saw nationally 10% depreciation in kind of the bottom years here. And then we've seen this kind of what I'll call parabolic increase in appreciation, which got as high as about 19% in 2001, which was kind of like the craziest appreciation year. But here's what's really interesting. If we lay these two graphs over each other, it starts to tell us a story. And it helps me understand where the market's likely going. So let's break this down. The black line is housing inventory, and the green line is kind of the trend line for housing inventory, which has consistently been going down. We see that in the years from, let's call this 1993, really through probably 2003. So we'll call that a good decade. The number of housing inventory was below the green line, which is the trend line. And that resulted in some pretty strong appreciation. We were getting up here towards almost 10% average appreciation, year-over-year appreciation nationally, right before the Great Recession hit. So we had a good period of time where inventory was below the trend line, and then we start to get this really aggressive appreciation because of the lack of inventory. Then the market shifts. We start to see inventory move higher. We immediately see appreciation go down and eventually end up in depreciation. This is when the housing stock in the country is over 4 million homes for sale. How do sellers get rid of homes when there's too much supply and not enough demand? They cut prices, and we see this, depreciation in the national market. But here's what's the most important thing for us to understand with this slide. Look at where we're at today. Today, in fact, going back to 2015, we have been for the last 7 years significantly inventory below the trend line. And today, according to the National Association of Realtors, how they look at inventory, we only have 1.3 million homes for sale. So this tells me that we're still, regardless of all the headwinds that the housing market has, in terms of a pending recession, rampant inflation, higher interest rates, 100%. Those are all headwinds for the housing market. But this slide would indicate that when the inventory is below the trend line, appreciation is likely to stay positive. Now, I don't think it's going to stay at 18%, and I hope it doesn't stay at 18%. It's unsustainable. We're pricing a whole generation out of housing. But to be at this kind of an inventory level, in order for housing prices to start to depreciate nationally, I'm not talking about isolated areas, right? Tampa, for example, I think was up 37% last year. Maybe there's some of those high cost of living areas that will see a little bit of reduction. But nationally, I don't think we're going to be looking at any kind of massive depreciation in home values until the inventory level gets above the trend line, which would be roughly 2.3 million homes. Jordan, I'm going to pause for just a second, take a breath. Any questions on that or anything you'd add?
I think, well, I'll open it up. If anyone has any questions, feel free to unmute and just ask, or you can throw them in the chat column. But I think this is really interesting because you're right. It's separating the facts from sort of the clickbait bites and headlines. And I think that, because people always ask me, I'm still actively investing and buying properties, and they always ask, well, why are you doing that? Aren't you worried that it's going to crash? And this information combined just with a lot of what I talk about and what as an investor, just focusing on cash flow and things like that, it
Yes.
to me just reassures and sets the sound kind of principles for successfully investing. And then I think it's interesting, looking at these charts and in terms of, my actual home, because we bought a home that we own. It kind of just using the same sort of principles, and time sort of cures everything. As long as you're not trying to sell your home tomorrow, it doesn't matter. These things are cyclical, and you kind of just watch and follow them and go from there. So it's really interesting having the data kind of distilled down like this. This is the first time I'm seeing this presentation too, and I'm learning a lot. So it's reinforcing sort of what what I've believed, and just further reinforcing the principles that I try to use.
Great. Well, that's great input, and I completely agree. And again, if anybody has questions, feel free to throw them in the chat. I've got the chat up here, and I'm happy to stop and answer them as well. And I'll stop periodically and prompt you for any questions. So what I don't want to do, Jordan, is in any way minimize the headwinds that are upon the real estate market. There are more headwinds now than there has been for probably 10 years. And so I do want to, give credit to that. And I personally, in my own investing style, I'm more conservative today in 2022 than I was in 2018, 2019, 2020, 2021. Or there was a moment there in COVID that I was pretty conservative with my investment thesis. But generally speaking, this is a more dangerous time, I feel, than it has in the past. So I want to give that some credence and be totally forthright with that. So here's the number of weeks supply of homes. This is according to Redfin. They measure data a little bit different than the National Association of Realtors, but clearly, and this is each year, right? So this is starting in January of 19. And then if we follow this along, this would be like December 31st of 2019. So it kind of just shows you year over year, you can start to see patterns. In 2020, we had COVID hit. Then all of a sudden, everybody was working from home, and we saw the supply of homes go way down. And now the black line, which is 2022, we're starting to see the number of weeks supply edge up. And, we're sitting right about 3 months supply of homes today for sale. But keeping just in terms of context, that's less homes than we had for sale in 2019. And 2019 had very robust appreciation. So again, if this number of inventory starts to get, up to say 5 to 6 months, so we get up in that 30 weeks of inventory up in this range, I start thinking, hey, we could see a national decline in prices, but we're still a long ways away from that amount of inventory. And by the way, builders have absolutely halted housing starts right now because the interest rate thing has freaked them out. So we're seeing a supply crunch on the new construction side starting to happen as well. This is the number of active listings across the entire US according to Redfin. Again, Redfin shows 838,000 active listings because they don't count those that are under contract like the National Association of Realtors. But again, we can clearly see that in 2021, we had inventory below 2020 and below 2019. And now the black line, which is 2022, we're now increasing the amount of inventory as compared to last year at this time, but not that much. We only have 4.27% more inventory this year at this time than last year at this time. But certainly the trajectory is starting to change. And then the last one that is definitely catching national news, and I'm seeing lots of articles around this, is the percent of active listings with price drops. So this is important that we understand. This doesn't mean that the value of sale prices of homes is going down 7.7%. That's what some people mistakenly understand from this headline. What this means is this: Jordan, you sold your home 4 months ago for $500,000, and I've got accustomed to the fact that real estate in the state of Utah, where I'm from, was appreciating at 30% a year. So I'm used to home values going up 2.5% per month. And so I figure if you sold your house 5 months ago at 500, then my house must be worth 550. And so I'm going to, and plus, I mean, have you seen my fence? It's the best. And so I'm going to list my house at 550. And then the market realities hit and I go, oh, it's not worth 550. I'm going to be lucky to get 510. And so you're starting to see these price reductions. These are people coming back to reality. I explained it this way. Home appreciation at 18% is like a freight train moving at 180 miles an hour. If we slow the appreciation rate from 18% to 8%, which I think is very, very, very likely, that's like the locomotive slowing from 180 miles an hour to slowing to 80 miles an hour. But they're still going forward. It's not in reverse. So we need to just make sure that we understand what's happening here. Yes, there's price drops, but we're not seeing real estate values, at least not nationally, go down. So two very different things there. So to kind of move on to the second question that I posed earlier, the first question is, why in the world are home values going up so quickly? The second question is 2022 a repeat of 2007? Well, so here's a few things for us to compare and contrast those two years. In 2007, there were 116 million households in the United States. We can just consider households potential buyers. And of course, not all of them are potential buyers, but some of them are renters, some of them don't qualify. But the buying pool, if you will, was 116 million. Also in 2007, there were 4 million homes for sale. That was the year that, we kind of hit that all-time high in terms of inventory. If you fast forward to 2022, there's 14 million more households. We have almost 130 million households, and we have 1.3 million homes for sale, according to the National Association of Realtors. So you have almost 3 million fewer homes for sale, and you have 14 million more potential buyers in the form of U.S. households. So when somebody says to me, hey, 2007 feels a lot like 2022 feels a lot like 2007, I say, okay, but if you really look at the data, it's not. It's very, very different. And I've got a few more slides to kind of point this out. This one's really granular. I'm going to try and explain it as succinctly as possible. I get better every time I explain it, Jordan, but this one is really so profound. I sometimes get lost in it. So this is the value of the aggregate U.S. single-family housing market, the total housing market. And today, in 22, it's worth about $40.6 trillion, which is a crazy amount of money, And the gold line, if you will, or whatever color this is the amount of outstanding mortgage debt. And so we've got $12.8 trillion in debt against the $40 trillion worth of housing value. But here's what I think super interesting. If we focus, and the blue line is equity. So the blue line would essentially be the difference. If you minus the debt from the total value, this is how much equity the U.S. homeowners have. But here's what I think is really interesting. The black line, which kind of bottomed in terms of U.S. home values, let's call it 2012, 2013-ish, has grown in terms of housing value from roughly 20 trillion to 40 trillion. So it's essentially doubled in 10 years. That's incredible. But look at the mortgage indebtedness. In 2012, the amount of mortgage indebtedness in the country was 10 trillion. The amount of mortgage indebtedness in 2022 is only 12.8 trillion. So what does that tell us? It tells us that in 2007, we were seeing this trend of mortgage indebtedness rise pretty quickly, because from 2000 to 2007, in 7 years, we saw mortgage indebtedness go from 5 trillion to, let's call it 11 trillion. So it, more than doubled in that 7-year period. But if we go from, 2012 to 2022, we look at that 10-year period, it only went up 2.8 trillion. So, and certainly Americans had enough equity that they have the equity to pull out. What this tells me is that the average consumer is not or the average homeowner rather, is not using their credit like an ATM machine. They're not funding their boats and their vacations and their depreciating assets. They're paying down their mortgages more than they're racking up the indebtedness on homes. And I'll just give you one other way to look at it, because I don't know about you, Jordan, but I have a hard time thinking in terms of trillions, probably because I've never had that many, numbers to deal with. But let's look at it this way. If we take 40.6 trillion and we drop off 8 zeros, because a trillion has 12 zeros. Let's drop off 8 zeros so we get down to a number we can think with. And let's not consider it every home in the United States. Let's just pretend it's one home, because it's way easier to think through. So if we take off 8 zeros from 40 trillion, we have a $406,000 value single home. And then if we take off 8 zeros from 12.8 trillion in debt, that would mean that we have $128,000 in debt. So we have a home worth $406,000. We have a $128,000 mortgage, which means our loan to value is 31.527. So if we put that construct on the whole US housing market, the country in aggregate, because a lot of homes are paid off, but in aggregate, the country only owes 31.527% loan to value. That is simply not a high risk loan to value. Any lender will tell you, I'm willing to lend on that market because there's a lot of equity there. A lot of the reason why that equity is there is because lending standards have been tight. This is the Housing Credit Availability Index. And one of the big problems that got us into 2007, the Great Recession, the housing correction, was the fact that there was a lot of lending risk. And they bifurcate this lending risk into two different constructs. Product risk. So let me give you an example of product risk. Jordan, you used to be able to do a negative amortizing loan. So your interest rate was 7%, but you only had to pay 1% in interest. So the balance of your mortgage was going up 6% a year. What could go wrong? They were adjustable rates that changed every 6 months or sometimes every 3 months. And a lot of those mortgages had 5-year prepayment penalties. That loan is literally illegal today. You can't write that loan without, going to jail or having a massive penalty. But there was a lot of product risk in the market from 1999 to 2007, and we cleaned that up. There are 30-year fixes, or there are 7 or 10-year fixed with very defined adjustment periods after the 7 or 10-year fixed period. There are 15-year fixed. There's very few prepayment penalties. I don't think there's any negative amortizing loan. So the product risk going down back to, essentially 2009 has essentially been zero. These are very safe loans that have been manufactured. And then there was a lot of borrower risk at this time. What's borrower risk? 580 credit score, 3 days out of a bankruptcy and foreclosure, didn't have to prove the income, and maybe the borrower didn't tell the truth on their commission or their bartending wages, if you will. So since 2008, 2009, we've had a more than a decade of very low borrower risk and essentially zero credit risk. And so if we go back and say, what caused the Great Recession? It was negligent underwriting standards. It was cheap, easy credit that caused people to become real estate investors on stated income loans that didn't have to prove. And then they gave a false signal to builders to build more homes. And then when interest rates went up, all of the payments on those loans skyrocketed. Nobody could make the payments. They then defaulted on the properties. That crushed demand when the credit dried up, and that caused inventory to go up. And then we saw the depreciation in values. But the reality is we don't have those risk factors today. Yes, interest rates have gone from 3 to 5.5% in a very short period of time. But so what? I locked my loan in 2020 at 3%. I don't care if, I do for the people who are out there trying to buy a home, but the fact that interest rates went up this year isn't impacting my payment, which is exactly what happened back in 2006. Although a lot of those loans were adjustable and they adjusted every 3 to 6 months. So when interest rates went up, the payment on my home today was affected. And that was really what cascaded into that event. So that's kind of the end of the market section. And I'm going to move into the strategies that I want to share, but allow me to pause for a minute again, Jordan, and see if you have anything that you want to add.
No, I think again, that's really helpful because the question is always, with what we're hearing now with inflation, with all this, is now an okay time to buy property? Just thinking from a purely a homeowner, not like an investing side of it. And it goes back, I just keep thinking to, there's like a concept I love and try to think about a lot, intentional spending. And again, whether it's a house or whether it's something I'm buying from, Target, I try to think, okay, does this purchase fit within my financial plan? Meaning, can I make the payments and still reach my financial goals? And then B, does the purchase bring me a joy greater than the price tag? And I think that's, my wife and I were lucky enough when we were looking for our first home that we had come across that concept and really tried to use it. And I think even with what you're saying, it sort of fits within that construct. And, if you're going to buy a place, you have to make sure first that it fits soundly within your financial plan. And then you want to make sure that it's the home that's going to bring you joy, that you're going to be there for a long time. And obviously none of us have a crystal ball, but we want to make sure we're happy in the city. But, when we looked, we said, okay, these are the criteria for the home we want. And that was a money criteria, but also like, okay, we want a yard for our kids because we're coming from New York City and we never had one. And we want this many bedrooms because we're planning a family this big, etc. And so that made it very intentional. And so this is a long way of saying, I think even in this market, what you're showing just proves the fact that if we go about it intentionally, then it still can be a very good time to buy, or really any time is a good time to buy if we're buying within those parameters.
Yeah, and the struggle is that timing the market is just so incredibly hard because there's always a reason why something is off kilter. And you said it best, time in the market cures all. And if you have a longer time horizon, you have a lot less risk. Well, you mentioned inflation, and I want to teach you my absolutely favorite concept around inflation and how it impacts debt, especially debt around appreciating assets. So I'm going to move into this first strategy, and the name of this strategy is Inflation Destroys Debt. This is a little heavy, so stick with me, but it's literally the most important thing I think I've ever learned in terms of giving me guidance and construct around how to build my real estate portfolio and why to do that. So this is the numbers that people see headlines of all the time. So July 2022, national home values according to Zillow, 355,000. That's an 18% increase over the previous year. Incredible. And I do think that appreciation is certainly going to slow from that breakneck speed. But what many people don't understand, and as a real estate investor, I really don't care about the appreciation. I have a fundamental belief that I like to buy properties and hold them for 100 years. That's my preferred asset holding period.
I second that.
Yeah, I saw this study, Jordan, recently that said, I think it was like, I can't remember who it was, Charles Schwab or something, and they said, guess which of our investors have the highest rate of return? Our dead ones. The ones who have died and their family just doesn't know what to do with their stocks, and so they just leave them for like 30 years. They outperform the living investors.
That makes sense.
Because they're not trading in and out of emotion. They're just saying, I'm betting on this company. I'm going to wait 40 years and see what happens.
Exactly.
So I don't look at the appreciation because I believe fundamentally that all my properties are my kids' properties. They're not even mine. I just get the fiduciary responsibility to take care of them and to maximize their economic viability. So what I look at is the increase in rent. And when you're having a 13.2% increase in rents from year over year, magic happens as an investor. Because the debt that you have on the debt that you have on the property, the payment stays the same, but the income from that property goes up. And as that income goes up, it's all just pure cash flow. Of course, maybe inflation causes your taxes to go up and your lawn care and a few other things. But this is really where the magic happens. Now, this is a case study. And there's a lot of numbers on this screen, so I'm going to try to make it as simple as humanly possible for everybody to understand. But if this sinks in and you get this could change your life. I know it changed mine. So, by the way, I learned this from a guy named Jason Hartman. He has a cool real estate page, jasonhartman.com, and I promise to give him credit. He calls it inflation-induced debt destruction, but that's too many words for me. So I just say inflation destroys debt. And what this is this shows an average home value in 1972 was $18,267. That's the actual average home value that year. Based on an 80% mortgage, this person would take out a loan of $14,614. The average mortgage rate in that year was 7.37%. They took out a 30-year loan. The monthly payment was $100.88. Love that payment. They did an 80% loan to value, as I mentioned, and we're going to assume that their tax rate was 33%. So those are the assumptions that this case study is built under. Down the first vertical column here, we have essentially 30 years to pay off this loan from 1972, gets paid off in 2001. And then we've mapped the corresponding inflation rate for each year. And the reason why I kind of wanted to look at this era is because we're now seeing similar inflation rates. We're currently sitting somewhere right around 9% of inflation. We're 9% inflation. If you believe the government numbers, I suspect it might be a little higher. And, but this shows a kind of a really cool illustration because we can see from 1972 to 1981, over that decade, we saw inflation range from 3% to as high as 13%. And it really puts an explanation point on the point of what happens to debt in these inflationary times. So here's the deal. In 1972, when we borrowed this $14,000, the value of the dollar was worth 100% of a dollar at that time. A dollar was a dollar. But next year, a dollar didn't have a dollar's worth of purchasing power because there was 3.2% of inflation eroded out of that dollar. So the next year, my dollar only bought 94 cents of goods and services. Then in 1973, inflation rate was 6.2%. So then in 1974, my dollar was only worth 84 cents. And if I follow this trajectory down from 1972 to 1981, the dollar only had 46 cents of purchasing power just 10 years later. And if we look over 30 years, at the end of the 30 years, because of the inflation each year eating away at the purchasing power of the dollar, at the end of the 30 years, the dollar only had 23 cents of purchasing power. That's incredible. So this next vertical column here shows the annual nominal payments. So $100 a month times 12 months, your annual payments are $1,200. Nominal means in name alone. If we think back to, let's say 100 years ago, they called a dollar a dollar. It was still a $1 bill. But 100 years ago, we could buy a lot more stuff than we can buy for that dollar today. So in nominal terms, a dollar is a dollar and it's constant. But in real terms, that dollar is worth less every year there's inflation. So this just shows in nominal payments, the payments were constant over 30 years. And there was $36,000 in payments that were written to pay back that loan over the 30-year period. But once you adjust for inflation, because think about this, if inflation is running hot during this period of time, then that means wages are going up. Now, I know some physicians have stopped me and said, well, wait a minute, physicians' wages aren't going up. Okay, I get it. There's some exceptions there to the rule. But generally speaking, in terms of economics, when we have times of inflation, real wages are going up. And if you were to turn this into an investment property and look at this through the construct of an investor, rents are certainly going up. As I showed in that previous slide, we've got 9% inflation according to the government, but Zillow's reporting that rents went up at 13%. So certainly we have rents going up during that time. And so if you adjust for inflation, the value of the dollar, each year, the actual amount that you're paying on that mortgage is going down. And if we look at it over 30 years and adjust for inflation, we really only paid back $16,392 on that mortgage. Now, these are real terms adjusted for inflation, not nominal. We have to bifurcate those two things, and we have to understand those two different ideas. But if we look at the real repayment, we only had $16,000. Now, it gets better. Let's assume that we were in a 33% tax bracket and we itemized our tax returns and we were able to write that off. Then once you adjust for tax deductibility, we actually only paid back $12,654. But wait a minute, we borrowed $14,614, adjusted for inflation, adjusted for taxes, we only paid back $12,654. Yeah, here's the summary. We borrowed, the nominal or name alone dollars to repay was $36,000, which was your original mortgage size plus your interest over 30 years, 7.37% rate. Your inflation adjusted dollars to repay was $16,000, which means your inflation adjusted interest rate was only 1%. Once you adjust for inflation and taxes, you actually paid negative 1.16% on that loan that you took out, on the money that you borrowed. Here's another way to look at it. It's a visual, and then I'll pause for questions. This charts this phenomenon, this inflation destroys debt phenomenon. In 1972, when the loan was taken out, the annual debt service was $1,200. But due to inflation devaluating the dollar, when you fast forward over 30 years, at the end of this loan, as the loan's paying off, you're only paying, it only feels like you're paying $200 a month because your income has gone up, or the rental income has gone up. Therefore, the other way you can look at it is inflation destroys debt. That was a lot. Let me pause and see if you have questions.
Yeah, that is really interesting. I know I'm gonna jump over. There was a question sort of from the last segment that came in. So I want to ask that, and then I know we're getting towards the end of our hour. So if you do have questions, just go ahead and throw them in, and we're definitely gonna have to have Josh back and go over some more of this stuff because this is really awesome. So we have a question from David. Says the inventory data from before makes total sense. However, I've heard there's a wave of foreclosures pending due to pandemic-related challenges. What are your thoughts on that?
I do not believe that there's a wave of foreclosures coming. And I will tell you why. Most everybody that has exited the payment halts, the mortgage payment halts through COVID has worked through the system at this point. And if you look at current foreclosure numbers, which I happen to actually just get an email in my inbox today that I might be able to bring up real quick and we can talk about it, are absolutely historically low. Now, here's the fact. The foreclosure numbers from last year have gone up a little bit, and that's the headline you're probably hearing. If I could spell foreclosure, what's going on here? There we go. But if you look at it in historical context, the number of foreclosures is still crazy low. So I don't see, and I'll go back to that, previous statement. Most people's mortgage payments are fixed. They all, people refinanced at 3% and 2.5%. So even though interest rates have gone up, here, I've got this real quick. I'm just going to share my screen again because I think this will really help give context. I literally just got this today, so I'm glad this question came up. Let's go right here. Okay. So this is foreclosure activity by year. And you'll see in the peak, we went from 1.3, 2.3 up to 2.9 million foreclosures. And today, actually, I'm sorry, this is 2021. There was 151,000 foreclosures. So those numbers were very, very low. I thought this was going to show us our most recent 2022 foreclosure numbers. Those are up slightly. That is true. This number is up. I think it's up like 40%, but 40% from what is the question? And so there are a little more foreclosures coming online, but way less than the numbers we've been seeing going back all the way to 2005. So is the percentage up? Yes. Is the amount of foreclosures getting anywhere near what we would expect to see a pull down in values? No, not even close.
Okay. I think that's really interesting. Any burning last questions for Josh, and then I'm going to ask him sort of to bottom line, like what is your advice in the current situation? So a rising interest rate, high inflation environment for a home buyer.
Yeah, great question. All right, well, I don't see any questions, so I'm gonna show one more slide here to kind of answer that question and bring it home. I do believe there's a recession coming. In fact, I believe we're already in a recession. And one of the reasons why is this is the Fed funds rate. And you can see, and the federal funds rate is the overnight bank lending rate that cascades into all kinds of other rates, right? It can affect home equity lines, it can affect credit cards, business loans, so on and so forth. But it doesn't have a direct correlation to mortgage. Interestingly enough, it actually has an inverse correlation to mortgage. As the Federal Reserve raises the Fed funds rate, it slows down the economy and oftentimes pushes the economy into a recession, which is the economy contracting. And as economies contract, you have deflation, which causes mortgage rates to go down. So I'm going to show this in graphs, but I wanted to give the overall context. So if we go back to 1955, we see this period where the Fed is raising the Fed funds rate. And after they're raised, boom, the black or the gray bars are recessions. Again, you see another Fed raise hike, recession. And this pattern repeats. Fed raises rates, recession, Fed raises rates, recession, Fed raises rates, recession. And this kind of pattern continues. So because the Fed is hell-bent on stopping inflation, they're raising the Fed funds rate aggressively, and I believe will continue to do so for the near term. That tells me we're likely to go into a recession, and there's probably 20 other reasons I could give you, but for time's sake, let's just say that's the number one reason. Inverted yield curve, things that are going on all over the world in terms of supply chains, all kinds of other stuff. But here's what happens to mortgage rates in recession. This is every recession since 1980. And you can see that in 6 months in the 1980 recession, mortgage rates went from 16% to 11.8%. And this is just very typical. Every time we go into a recession, mortgage rates go down, mortgage rates go down, mortgage rates go down, mortgage rates go down. And I believe that's exactly what's going to happen in the recession that we're going to go into. Now, what freaks everybody out, and I think this will answer your question, recessions do not equal a housing crisis. We have recency bias. The recession that we're most anchored into, most of us, is the Great Recession, because that one was painful. You know, the COVID recession was like really too fast and had too much stimulus to really be painful for a lot of people. And so the recency bias we have is the Great Recession, which was a housing bubble and debt recession, and housing prices did go down during that recession. But if you go back to 1960, you see that housing prices actually went sideways to up through every single recession we've had since 1960, barring the 2006 to whatever that was, 2007 recession, including what happened in COVID. Housing prices went up. So and I'll give you one other graph and then I'll bring it home on that answer. This again just shows another graph of the housing values in recessions. Essentially, housing goes up, or 1.9%, like rounding error down in 1991. But housing does actually pretty dang good in recessions. And I'm gonna bring it home and bring down these slides, but I do want it to be invited back, because the last thing the next strategy I want to teach you is how to reduce or eliminate taxes through real estate investing. So I thought that might be a good hook to get an invitation to come back to you all. But so here's my thesis on where we're headed. And I think this was really your question, Jordan. I believe that appreciation is going to slow dramatically because the interest rates had made housing really unaffordable for a lot of people. And that's going to slow down the demand. So appreciation will slow. The locomotive will slow from 180 miles an hour to maybe 40 miles an hour. Maybe we'll only see 4% appreciation next year. That's not a housing crash. What will also likely happen during that time period is we will officially enter a recession. Something's going to break, whether it be because of the strength of the dollar or numerous other things that are going on in the world economy that all seems to be slowing down at the same time. There's this moment where people are like, holy crap, the economy or this thing in the economy has broken. At that moment, we'll officially enter in a recession. There will be some panic. I believe that interest rates will go down, making housing more affordable, and we'll bring some people off of the sidelines that have been waiting it out, and we'll bring the housing market to kind of its next leg up, if you will. I don't think we hit 20% appreciation again, but I don't see we see the massive depreciation that we saw in the Great Recession.
Awesome. Thank you. And I wanted to get in, we had a great question come in from AZIF. So looking to buy multifamily properties with rising interest rates, definitely affecting cash flow, yes. Question is, do I focus on properties which cost relatively low, which I can rehab, add value, raise rents, and hope to cash out refi down the road when rates are lower? Downside is that the cost of rehab is higher. Or should I buy more turnkey properties? I lose out in value add and building equity. I'll quickly give my thought, and then you are certainly have a lot more experience in investments, and so I'm interested to hear what you say. I just closed on a property that was very turnkey that now we have rented out and is cash flowing around 18%. And we still, my wife and I, we are in the process of closing on another property that is very much a lower cost rehab, add value kind of opportunity. And that, in theory, based on our numbers, has an expected conservative cash on cash return of about 14%. So I think that both are still very doable, and you kind of just have to run the numbers and see what works. And so the interest rate doesn't really change my thinking about that, other than knowing just, we're looking a little bit harder for deals than we had in the past, just because the numbers aren't working as well as they have. But in general, the interest rate hasn't made or broken anything. So that's my thought, but I don't know, Josh, what do you think?
No, I'm very much aligned with you. I've bought more real estate in the last 3 years than I have in the previous 19. And the reason that I have done so is I had a fundamental belief that we were going to have inflation because of all this stimulus. And I thought rents were going to go insane. And so I wanted to buy properties that enabled me to raise the rent every single year. So the office buildings I have, the medical office space, they all have inflation adjustment clauses that enable those lease rates to go up every year with inflation. On my apartment buildings and single family homes, those leases come up annually. And so we're able to adjust for inflation. So if you can find cash flow, a property that cash flows today, regardless of which type it is, and you have the team to manage and to do that for you, I believe you're going to do very well in the years ahead for two reasons. I think we're going to, I think we're likely to see elevated inflation, bouts of elevated inflation, followed potentially by a recession and then more inflation. And I think that inflation is going to continue to push up rental prices. But I also think there's going to be huge opportunities with a recession where you can refinance all the debt on all of your properties, lower your debt service number, or extract equity in some of that capital that you have parking in those buildings and then redeploy that with new investments. So as long as you have cash flow now, I think you're going to do very well in the years ahead.
Great point. So very quickly, I'm already going to email you after this to set up our next one session. So don't worry about that. How, if people have more questions or want to reach you, what's the best way they can do that?
Yeah. And if somebody wants like a one-on-one, hey, let's just get on 30 minutes. Let me tell you what I'm doing. Let me get your opinion. I'm more than happy to do that too. So the easiest way to do it is just josh@joshmettle.com. And I'll send you my Calendly link, and you can just schedule up something that works well for your calendar, and we'll spend 30 minutes and I can answer all your questions.
Awesome. Well, thanks so much for your time, Josh, and thank you everyone for joining us. I hope you found it as interesting and educational and fun as I did. And we'll be setting up another one, so keep your eyes out for that.
Very much look forward to it. Thanks, everybody. Have a wonderful evening. Thank you,
Thanks,
Jordan.
everyone.